I'll start by making a few observations on Uganda. In a speech on April 16, marking the start of the Bank of Uganda's 50th anniversary celebrations, Governor Emmanuel Tumesime Mutebile noted, quote, "In the coming decades, our monetary policy will continue to prioritize, above all else, the control of inflation. This is because low and stable inflation is a precondition for mobilizing high levels of savings and investment for efficient resource allocation, which are essential for sustained growth," unquote. In a speech last November on the role of the central bank in the post-2015 era, the governor also observed, quote, "Sound monetary policy is a prerequisite for a stable macroeconomy with low inflation, although it is not always sufficient in the absence of sound fiscal policy," unquote. I'm delighted to say that the Bank of Uganda practices what it preaches. I know not all of you may agree, and I'm sure there'll be a debate on this. But it has tried. If you put it to an exam, I'll say it has not been scoring too badly. Last year, in the face of a depreciating currency and rising inflation expectations, the Bank of Uganda upped interest rates by 600 basis points, the highest of any central bank in Africa. And I know that some did not like this. But this eventually stabilized the exchange rate, even leading to a nominal appreciation of the Ugandan shilling against the US dollar. The willingness to hike rates indicates clear resolve on the part of the bank to meet its medium-term target of 5% for annual core inflation. It also preserves foreign exchange reserves at a time when these are a crucial buffer against global uncertainty, and is definitely preferable to introducing restrictions to stabilizing the exchange rate, which fuels parallel markets for foreign exchange, lowers central bank credibility, and hurts the private sector and economic growth. And we have examples of this all around the continent. But one should be clear that the ability to hike rates in this fashion would not have been possible without good economic governance and assured central bank independence. And so I also congratulate the political authorities in the country, the parliament, the president, and the leadership for giving the Bank of Uganda some room. I know this is not always the case. We have a debate going on now in some neighboring countries. I'm sure our colleague from Kenya will have to worry a little bit about the move for legislation on interest rates. So we also have to thank our political leadership when they leave us alone to do the good technical thing and give us the independence. The positive effects of last year's prompt hikes have enabled the Bank of Uganda to cut its policy rate by 200 basis points this year. In addition, the scale of monetary policy tightening in 2015 would not have been feasible had public indebtedness been excessive, because this would have immediately worsened public debt dynamics. And in a sign of pragmatic self-confidence, Uganda has entered into an agreement with the IMF on the Policy Support Instrument Program, which enhances credibility by signaling that macroeconomic policies are sound and the country does not need balance of payment support. But good monetary policy needs to be supported by sound fiscal policy, by sectoral and structural reform. We have seen some positives on this in Uganda, but challenges remain. Uganda's recent economic performance has been favorable. Its fiscal policy stance has focused on enhanced revenue mobilization and improved public spending efficiency with some success, creating room for priority social and infrastructure investment. GDP growth has been significant, averaging about 7% over the last 2 decades, which is higher than the average growth in sub-Saharan Africa for the same period.